Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, March the 6th. Yes, I did miss Monday, March the 5th's morning market commentary because I screwed up and forgot to record the sound. Not a whole lot missed there. We did have a little bit of economic data, but most of it was relatively not that important. One thing that we did get was across the pond in Great Britain, we got services PMI coming in slightly higher than expected yesterday. And then we got our ISM non-manufacturing PMI came in at 59.6. That was yesterday. Here in the United States, or actually, and we also had a Fed governor speaking. Then today, not a whole lot of economic data across the pond. Again, we do have Dudley speaking, who is an FOMC member, spoke this morning right on the open. And then we, here in the United States, have another Fed member speaking, Bernard. That is later on this evening. And one other thing that I wanted to talk about was we got factory orders, you guys. And factory orders was a negative 1.4%. It was expected to be a 0.4%, but 1% less than expected. Now, we would expect factory orders to kind of slow down coming outside of the holiday season, but we are starting to see inventories rise, factory orders kind of weighing off across the pond and here in the United States. We're going to have to really keep track of this because, the Fed's been raising interest rates and they're trying to crimp spending in a sense. And when you raise interest rates, that kind of creates this saving mentality. And I don't know that they really want to do that right now because we want to continue to see our economy kind of churn along. I don't think that we're at a point where we need to stifle this economy. And I don't think we're seeing we're not seeing inflation. So it doesn't really bode well for the overall economy. We have to remember they have a mandate to try and keep money or make money now because of all the things that happened in 2008 and 2009. And they have a balance sheet. So they aren't really neutral, if you will, because they have to look at their investments now. So that's not a very good thing. All right. Anyway, on to the overall markets. We got crude oil futures moving slightly lower by about 26 cents. But a lot of these markets, you guys, while we're looking at these charts, are starting to look like turnaround Tuesday is what we used to call it on the floor. It's like turn those hands around and, you're buying coming in. But on Tuesday, it has a theory that is a turnaround day where you get a correction. I don't know where that came from. Maybe just because it rhymed a little bit. But that being said, we are seeing a lot of these markets create somewhat of a toppy pattern. We've got the crude oil lining up right with the 50-day and the 9-day moving averages, as you can see here. You can see that as it approached that trend channel, it did start losing steam and has come off not quite the lows of the day, but very close. Let's move on to a couple other things. With the gold futures blasting higher, equities are coming off a little bit. We were talking about this being an inflation trade, but it is also a flight to safety in a sense. But with the gold futures up about 17 points, I was looking for it to roll over a little bit more. But today's blast off right through the 9-day, the 50-day, and Fibonacci level value area high. That's a pretty strong move. I thought it was going to want to trend down and roll over, but it is not doing that. This doji here, very strong, as you can see. All right, Bitcoin. I've switched it over from a 30-minute chart to a daily chart because I think we're getting a pretty good idea as to direction and where the market really wants this to go with the Fibonacci's on here still. But as you can see here, I don't even have a 200-day moving average here, right? It's only a 50-day and it just started there. So all of that being said, this is looking like resistance up here at around this 1200 area and now starting to roll back over. This being on a daily chart, we're getting a much different volume profile. Remember, our volume profile was showing it as the high was right down here around 10,000. That on a daily chart has moved up to around, let's call it 11,000, but we have peeled right through that. That's going to be where the most time and volume's been spent. That's going to be the comfort zone that I'm going to keep an eye on. All right, VIX is moving higher today. It's not up into the 20s yet, close to the 19s, but that is all because we're seeing the equities start to roll over again. As you can see with the Dow Jones Industrial Average after yesterday's Big rally, giving up almost 100 points, just a little over 100 points today. This chart doesn't look as toppy as the rest of them, but remember, this is just the day session because of that Dow Jones index. This is the NASDAQ, which is traded at the Chicago Board of Trade. This, as you can see, we've had that big rally yesterday. It's starting to look a little bit toppy. Well, we don't have confirmation on any of these yet, but a little bit earlier, they were looking a little bit more toppy. Anything settling up near this Fibonacci level is probably going to look more of a continuation, and especially if it breaks above there. So that's something to keep an eye on. Very quiet, though, today so far. As you can see, with the breakdown of the E-mini S&Ps on a 30-minute bar chart, each one of these blue sections, in a sense, is the each day session. And as you can see, what I was going to say, when we get over here towards the opening of the day, we have just kind of fallen out of bed. It just really had the overnight inventory long, and we're flushing that out. Yet to be seen what's going on after that, but also very inside day with the point of controls lining up quite nicely, value area highs lining up quite nicely as well. That makes it a very inside day. That isn't a great scenario for trading. All right, on to the earnings trades. Target. Now, I had a personal fast market this morning. I woke up, logged in, and lost all my I lost my watch list, lost all my charts, so I had to redo all my charts. I was trying to scramble to get everything together, and started noticing Target was doing pretty good right off the open. I mean, it was down a little bit, despite the fact that they missed by just a couple of pennies. I tried to start getting out of this, started chasing it till basically a scratch. So in Target, I went in there and had sold the March weeklies that expire on Friday, and did the March weeklies, sold the 70 puts in there for, sold the 70 puts, let's talk about my IRA, sold the 70 puts, defined the risk by buying the 62 puts in there, and I did that for 46 cents. Today I came in, scrambled to cover those, got a little bit away from me. I probably could have covered these about 10 or 15 cents better had I done it immediately on the open, but I was really was scrambling all over the place. But I bought those March, just the 70 puts back in my IRA for 45 cents. So not a great trade there. Over in my margin account, I went in and sold the same March 70 puts in there for 50 cents and then bought them back for 40 cents. So I got a little bit better pricing in my margin account than I did in my IRA. For all intents and purposes, it was a scratch for both of those, the way I'm looking at it, with the commissions and everything else. But got out in time before it really started selling off. I think it was down $2 when I finally ended up getting out. Then on to the next one was Intel. Now, Intel blasted up. Remember, I talked about these tweezer top act. Thing has a bunch of resistance here. I thought it was going to be a pretty major resistance. We gapped up today on the open, pretty much on nothing other than the market. When we broke through and pierced through this tweezer top, I got a little bit nervous. I'm not going to lie. So I don't often do this, but I have done it in the past and it's worked out. So I'm not really recommending this as a way to manage risk. I'm playing around with this. It's worked out before in the past, and I've been meaning to test this out again. Anytime I'm inside that 10 days to expiration, which I've kind of let these kind of go in, a lot of my short options are going into that last 10 days, which we really get that theta decay, but a lot of these strategies weren't working out. Today, with Intel moving higher like it has, I decided to go in and sell some additional puts to kind of create a strangle in my margin account and an iron condor in my IRA. Now, it is an iron condor in my IRA only because it has defined risk strategy. I'm not looking at that defined risk as the risk I'm willing to take, but it does save me on margin in my IRA. So it's really both synthetic strangles, even though it really is, quote unquote, an iron condor in my IRA. I've built it so it's like a synthetic strangle with those just nickel options that I define the risk with. But having said that, I went in there and decided to add some short puts in there, create that. And in my IRA, I went in and did the March that expire on the 16th. Did the sold the 49, or sorry, sold the 46, sorry, sold the 49 puts, bought the 46 puts, and I did that for 29 cents. So just trying to add a little bit of credit to this. It's a really tight strangle, not super in love with it, especially since we started getting this bit of a comeback. You know, when I put this on, my short calls were in the money when I added these puts. So then if we look back at my margin account, I went in and did the same thing with Intel and sold the March, but I only sold the 49 puts naked for 34 cents. So now I have on strangle in both of those. I am short the March 51.49 strangle in my margin account, and then I have the synthetic 51.49 strangle in my IRA. So hopefully we can get a bit of a pullback, trade sideways, cover this gap for a couple of days, and I'm going to try and get out of that for hopefully around a scratch, if not just slightly better for Intel. And that's about it for today. I haven't added anything else to my margin account. It literally took me about 2 hours to set up all my charts again the way I'm used to them, and get my watch list back and a lot of other things. So I've been kind of in a personal fast market over here, is what we used to call it on the floor when nobody else was busy, and you're scrambling like and running around like a chicken with your head cut off. And that's what I was doing this morning. So that's about it for today. Friday's webinar is going to be a great one. It's going to be on the long straddle. So check that out. I'm going to be doing long straddles, long strangles for the next couple of weeks. So check those out. Great entry level strategy for a newer trader to get their feet wet with options. It's not my favorite strategy because I don't like buying options necessarily, but there is a time and a place for this strategy, and I'm going to show you when and where it is best to put this strategy on, what type of environment, and what the strikes are, especially in regards to the strangle, okay? So go to protraderstrategies.com and sign up for that. If you can't take that, take it easy.